Hi, this is Kathy Uckert. I'm a senior analyst here at Value Line. Another senior analyst, Alan House, joins me today. Today we are going to provide an update on the economy and stock market. We will then discuss our Value Line Select Dividend Income and Growth product, and finally, answer any questions you may have. Please note that this presentation will be available on our website, www.valueline.com, and on our YouTube channel within the next 48 hours. All previous webinars are also posted. Before I jump into the heart of the presentation, for those joining us for the first time, I want to provide a brief overview of who we are at Value Line. We are a New York headquartered corporation that has been providing investment research for more than 90 years. Our flagship product is the Value Line Investment Survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis on equities that trade on the New York Stock Exchange, the NASDAQ, and the Toronto Stock Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly, is created by Value Line's research department, which is comprised of nearly 70 analysts, economists, data experts, and quantitative specialists. One thing I want to stress is that our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, Value Line has no investment banking business with any company, including all the equities under our coverage. Value Line does not execute trades for its subscribers and therefore has no stake in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. If you have any questions about the products or services we offer, or our different tiers of subscriptions, that information can be found at valueline.com, or you can call 1-800-VALUE-LINE. Now let us discuss the economy and the stock market. Value Line's economic staff prepared this content. The latest round of inflation data was mixed. The September Consumer Price Index came in above forecast, with the headline figure rising 2.4% over the 12-month period. That tally was down from the previous month's reading of 2.5%, but above the consensus estimate of 2.3%. However, the companion report on producer prices was benign, with prices at the wholesale level increasing just 1.8% year over year. In all, the data did not change the narrative that the Federal Reserve will likely continue to cut the federal funds rate at the next monetary policy meeting. That said, the central bank is now likely to reduce the benchmark short-term interest rate by a quarter point at the November Federal Open Market Committee meeting. The September price data suggests that a modest interest rate cut, or even a pause is appropriate. But the Fed also doesn't want to risk putting pressure on the labor market, which held up very well during the increasingly restrictive monetary policy course. The September labor report, which included an estimated gain of 254,000 jobs and a downtick in the unemployment rate, was strong. But the Fed appears more worried about the months ahead. On point, initial jobless claims during the first week of October spiked to 258,000, far exceeding the consensus forecast. Third quarter earnings season is in full swing. The initial returns were favorable, with the big money center banks exceeding profit expectations. Overall, the consensus is calling for mid-single-digit earnings growth, on average, for the S&P 500 companies. This is likely needed to justify the elevated price-to-earnings multiple for the index. The environment overseas is unsettled. There is escalating fighting in the Middle East and Ukraine, which continues to threaten global supply chains. Meanwhile, China's economy, plagued by deflationary pressures, continues to struggle, so much so that Beijing is expected to implement a sizable stimulus program to boost the world's second largest economy. In conclusion, the major equity averages were at or near record highs in mid-October, with the recent economic data keeping the possibility of a soft landing in place for the U.S. economy. That assuaged concerns about domestic growth and pushed investors back to riskier holdings. So now I will walk you through the selection process for the latest stock to join the Value Line Select Dividend Income and Growth Featured Portfolio, Enterprise Products Partners, LP. It trades on the New York Stock Exchange under the ticker symbol EPD. I will now show you how to access it. Once signed in, head to the dashboard, where I am already located. This is the main landing page for subscribers, where you will find economic commentary, supplementary reports, and other up-to-date content. From there, we want to choose Browse Research and navigate to the screener. One thing I want to touch on is that the screener is just one element of our selection process and helps us sift through the thousands of equities in our database using targeted, relevant criteria. Anyone can randomly select different screening criteria and come up with a list of stocks. But what separates Value Line Dividend Income and Growth is that this is a curated process, starting with specific complementary criteria to meet our requirements. Step 1, safety rank of 3. We want to focus on companies that are at least as safe as the average equity under our review. Hence, we will focus on companies that are ranked 3 or better for safety. Keep in mind that our safety system ranks stocks from 1 to 5 based on their relative risk profile. After screening for this, we have whittled our list down to 2,172 stocks. Step 2, financial strength rating of B++ or better. This metric measures how financially sound a company is. When taken together with an average safety score, we are focusing on companies that are financially healthy, with stocks that tend to be no riskier than the broader market averages. After screening for this variable, we have narrowed the list down to 960 stocks. Step 3, timeliness rank of 3 or better. We want to focus on stocks that are ranked to at least match the performance of the broader market averages in the year ahead. After screening for this factor, we are now down to 617 stocks. Step 4, dividend yield of at least 7%. We want to also look at the dividend yield. While we are looking for stocks that have solid dividend growth potential, we also want to focus on equities that have a yield that is well above the value line median. After conducting this screen, we are down to 8 companies. After a spirited discussion among our senior analysts and our chief economist, we decided that Enterprise Product Partners, LP, would be the newest featured selection for the value line dividend income and growth portfolio. Now about the screener, value line subscribers have access to 15 preset screens and 50 fields. I should also mention that another 100 or so fields are available, but it requires a higher level of subscription. If this interests you, please call 1-800-VALUE-LINE. Please note that screens can be saved and revisited by utilizing the Create Save Screen button at the top of the page. Now let us click on Enterprise Products Partners, where we find the landing page for the stock and the value line's digital report. We can also click on PDF reports near the bottom of the page to find the most recent full-page reports on Enterprise. Let us now look at the most recent value line dividend income and growth report. So the Enterprise Products Partners, which is published very recently, is on the site. And you can scroll down and see the details of the report. And then here on page 8, you can see we look for the company to post solid top and bottom line gains next year on the heels of a likely sharp earnings increase in 2024. Enterprise Products is a major player in the lucrative Permian Basin, which is located in West Texas and the adjoining area of southeastern New Mexico. Why is the Permian Basin so profitable? The region's unique rock characteristics make the Permian Basin one of the most prolific fields in the world. Its geology enables a single well to produce oil and natural gas from several layers of rock in different geological zones. This phenomenon multiplies the basin's natural resource potential. The company has multiple projects in the Permian Basin, including natural gas processing plants and pipeline expansions. Enterprise is also expanding its presence in the region via a pending acquisition. It has agreed to purchase Pinion Midstream in a cash deal valued at $950 million. The transaction is expected to close during the fourth quarter of this year. Enterprise Products Partners stock is a solid choice for investors seeking a high degree of dividend income growth potential. We project that the distribution will climb as a low double-digit annual clip on average over the 3 to 5 years ahead. This is markedly above the value line median. These shares also offer above average capital appreciation potential over the 18-month and 3 to 5 year stretches. Earnings are expected to climb at a mid-single-digit clip through the 2027 to 2029 timeframe, while PE multiple expansion might well be in the cards. Prior to 2018, the stock commanded a premium multiple relative to the broader market. We believe that the valuation might well increase closer to historical levels over the long term, given Enterprise's strong earnings prospects. Generally speaking, we try to hold positions in the dividend income and growth portfolio for at least 6 months before considering a sale. Of course, that depends on the broader economic conditions and the health of the overall stock market. Generally, we try to diversify the dividend income and growth portfolio across a variety of sectors in order to help boost the overall return. While it may be tempting to focus on stocks in a high growth segment, as the old adage goes, it's not a good idea to keep all of your eggs in one basket. It also should be noted that while we screen for dividend income and growth selections, we also discuss qualitative factors that may add value to parameters that we screen for. The screens are good for quantifying metrics, though sometimes there are qualitative or intangible variables that are difficult to incorporate into a screen. Product brand awareness, management, and susceptibility to sharp economic downturns are just a few examples of factors that may be difficult to screen for. We hope this gives you a good overview as to how we screen for dividend, income, and growth stocks, and what is included in our monthly report. We will now tackle a few questions. Please note that we typically cannot answer complex questions without specific stocks on the spot. The first few questions were submitted prior to this presentation. I will now hand it off to Alan.
Thank you, Kathy. Thank you all for joining us. The first question was an interesting one. What factors should you consider for dividend-paying stocks? And there's many factors you should consider. I'll go through them one by one. First off, there's the dividend yield, which the dividend yield is the annual dividend payment as a percentage of the stock's current price. It is a key metric for evaluating how much income you'll receive relative to your investment. The second variable is the dividend payout ratio. The dividend payout ratio is a percentage of a company's earnings paid out as dividends. It helps to assess whether the company can maintain its dividend payments. A payout ratio that's typically between 30 and 60% is fairly normal. A lower ratio may indicate that the company is reinvesting for growth, while a higher ratio, such as 80% or better, could signal that the company is distributing too much of its earnings, which might not be sustainable in the long run. Investors should also look at the dividend growth history. Dividend growth refers to the company's track record of investing its dividend over time. A consistent history of raising dividends signals a company's financial strength and management's commitment to returning value to its shareholders. What to look for here is companies that have increased dividends for many years, ideally 5+. There's also the financial health of the underlying company. A company's ability to maintain and grow dividends is tied to its overall financial strength. Strong cash flow and manageable debt levels are essential for a company to continue paying dividends, especially during tough economic times. There are several factors to look for here, including strong free cash flow, low debt levels, and a consistent earnings stream. There's also business stability within the sector. Some sectors are more reliable for dividends because they have stable and predictable business models. Utility, healthcare, consumer staples, telecom, those are a few that come to mind. It's best to look for companies in stable, recession-resistant industries such as utilities, consumer staples, and healthcare. These businesses often generate consistent cash flow even in tough economic times, which supports reliable dividend payments. There's also management's commitment to dividends. A company's management's philosophy towards dividends is important. Some management teams are more committed to returning profits to shareholders than others, while the others might prioritize reinvestment or acquisitions. There's also the company's valuation. A company's stock price in relation to its earnings, assets, and dividends can tell you if a stock is overvalued, undervalued, or fairly valued. It's best to look for stocks that are fairly valued based on price to earning, price to book, and price to free cash flow. There's also the dividend coverage ratio. This ratio measures how well a company's earnings can cover its dividend payments. A higher dividend coverage ratio means that the company is less likely to cut its dividend. A dividend coverage ratio of 2 or above is ideal. It means the company is earning twice the amount it needs to pay its dividends, which gives it a safety buffer in case of unexpected declines in earnings. Finally, there's economic and market conditions, such as interest rates and inflation. Dividend-paying stocks can be sensitive to changes in interest rates. In a rising interest rate environment, fixed income investments like bonds may become more attractive, making high-yielding dividend stocks somewhat less appealing. Also, inflation can erode the purchasing power of dividend income, so look for companies that have a track record of increasing dividends faster than the rate of inflation. Thank you.
Well,
I see another question here. This relates to the company specifically. What's the difference between upstream, downstream, and midstream companies? And this is a very good question. Let's go, piece by piece on this. Upstream companies are involved in the exploration and production of crude oil, natural gas, and natural gas liquids. Their activities include finding oil and gas reserves through exploration, drilling wells, and extracting those resources from underground. Their key operations are exploration, drilling and extraction, and production. Some of the examples of upstream companies are ExxonMobil, Chevron, and ConocoPhillips. The risk involved here is these companies are highly exposed to commodity price fluctuations as their revenue depends directly on the market price of crude oil and natural gas. These are also known as E&P, which are exploration and production companies. Now, midstream companies are responsible for the transportation, storage, and processing of oil and natural gas liquids. They act as a bridge between the upstream, the production, and downstream companies. Midstream companies generally move the products from the extraction site to processing plants or end markets. Their key operations are transportation, storage, and processing. Examples of midstream companies are, as we mentioned, Enterprise Products Partners, Kinder Morgan, and Enbridge. They do have risks, however. Midstream companies are generally less exposed to commodity price fluctuations because they can earn revenue based on the volume of product transported or stored rather than the price of the commodities themselves. So they're actually less risky overall than upstream companies because they're less susceptible to commodity price fluctuations, which is a positive. And finally, downstream companies. Downstream companies handle the refining of crude oil, the distribution of refined products, and the marketing and sale of petroleum products, such as gasoline, diesel, jet fuel, and petrochemicals. This is the final stage before products reach the end consumer. Key operations here include refining, distribution and marketing, and also petrochemical production. Examples of such companies are Phillips 66, Valero, Shell, and BP. Downstream companies are sensitive to refining margins, which are affected by the difference between the cost of crude oil, which is the input, and the selling price of refined products, which is the output. They are also affected by consumer demand for refined products. Thank you. I believe that's all the questions we had today. I would like to thank you all for joining us. I'll